Two retired blokes, same age, same suburb. Both walked away from work with $500,000 in super. One of them is drawing a steady, tax-free income every single fortnight, pays zero tax. The other one invested everything in blue-chip ASX shares, getting fully franked dividends. And every July, the ATO sends him a check in the mail. So which bloke has more money in his pocket at the end of the year? That's exactly what we're going to find out today. Real numbers. 2026 rules. No spreadsheets, no jargon. Because this is a question every man over 60 in this country should be able to answer before he makes a single decision about his retirement income. And most can't, because nobody ever explained it to them. I'm Gramps, and that stops today. Here's the problem. Most blokes retiring in 2026 still have their super sitting in the accumulation phase. Earning money, yes, but getting taxed at 15% on every single dollar of those earnings. Meanwhile, they're holding shares outside super, getting dividends, but they're not sure how the franking credits work, whether it counts as income, or what Centrelink is going to say about all of it. And the window to fix this is closing. From the 1st of July 2026, the transfer balance cap, that's the maximum amount you're allowed to move into a tax-free pension account, goes up to $2.1 million. Sounds like good news, and it is, but only if you know what it means and actually do something about it. The bank manager won't call you. Your super fund won't send you a letter that says, "Mate, you need to make a decision this month." They just keep collecting fees while your money sits in the wrong place. So I'm going to break down both options, side by side, and then you decide which one fits your situation. Let's start with the account-based pension, or ABP. When you retire and move your super into an ABP, something powerful happens. Once you're aged 60 or over, every single payment from that account is completely tax-free. Zero. The ATO doesn't touch it. And the earnings inside that account? Also tax-free. Your money is growing in a zero-tax environment. Now, there's a catch. There's always a catch. The government requires you to draw down a minimum amount each year. It's based on your age and your balance. Age 60 to 64, 4% of your balance per year. Age 65 to 74, 5% of your balance per year. Age 75 to 79, 6% of your balance per year. So if you're 67 with $500,000 in your ABP, you must draw at least $25,000 a year. That $25,000 lands in your bank account, tax-free. But here's what most blokes don't think about. That ABP balance counts under Centrelink's income and assets tests, which can affect your age pension entitlement. As of early 2026, the deeming rate on financial assets is 1.25% on the first $64,200 for a single. Centrelink doesn't care what your money actually earns. They deem it earns a fixed rate and assess you on that number. That's the system. Not fair, but that's the system. And knowing it is the first step to working around it. Now let's talk about the other bloke, the one holding blue-chip ASX shares outside his super. When a company like BHP or Commonwealth Bank pays you a dividend, they've already paid 30% corporate tax on those profits. The government says that counts as tax paid on your behalf. They call those franking credits. Here's where it gets interesting for retirees. If your personal tax rate is lower than 30%, or zero because you're drawing income from an ABP, the ATO refunds you the difference in cash every year. $1,000 fully franked dividend received, $429 franking credit attached to it, $429 cash refund from the ATO at 0% tax. A $1,000 fully franked dividend becomes $1,429 in your pocket. That's a 43% bonus from the tax system, just for owning Australian shares. The banks and the financial press will tell you term deposits are safe, and maybe they are. But they don't mention that a franked dividend from a solid ASX company can pay you more after-tax income than a term deposit paying double the rate. They don't mention that. But Gramps does. BHP's forecast dividend yield right now is around 5%. Factor in the franking, and that becomes closer to 7.5% grossed up. Not a bad result when the bank is offering 4.5% on a term deposit. So, which one wins? The honest answer, for most blokes, it's not a competition. It's a combination. Your account-based pension gives you a stable, tax-free income base. The structure is clean. The tax is 0. The drawdowns are predictable. Your franked dividends, held inside your super's pension phase, or in your own name once your taxable income is low, layer on top of that. The ATO refunds become cash flow. That cash flow pays your council rates, your groceries, your holidays. The blokes who retire well in 2026 aren't the ones who picked one or the other. They're the ones who understood how the two systems talk to each other and structured their money accordingly. One thing worth flagging: if your total super balance is above $3 million, there's a new tax kicking in on the 1st of July 2026. It's called Division 296, and it adds a 15% tax on certain earnings above that threshold. If that's your situation, it changes the numbers a bit. We'll do a full video on that one very soon. Now look, I'm not a financial advisor, and nothing I say here is personal advice. Your situation is your own. But what I can do is make sure you walk into any conversation with any advisor knowing exactly what questions to ask and exactly what they should be telling you. That's what this channel is for. Finance that feels like family. If this helped you today, hit subscribe, because next week we're going over the 2026 federal budget and what it actually means for your age pension and your Centrelink assessment. Not the headline, the details they buried on page 47. Stay smart, mate. Gramps out.